Market watcher David Stryzewski is with me this morning. Question, David, does the downgrade change your forecast for the stock market this fall?
Hey, good morning, Stuart. Great to be with you. So I'm not surprised by this downgrade. In fact, you'll recall I've been saying this for a long time. In 2011, ironically, August 2011, we were in the exact same moment. Higher debt to GDP spending, political stalemate. These were literally the things cited that caused the downgrade in 2011. Now we're in this weird spot where there's nations like Singapore and Norway that are more creditworthy than us, and also companies in the U.S. that are more creditworthy than the United States right now. So, what's really been going well for the United States dollar is this Fed strength of saying, hey, we're gonna tighten, we're gonna raise these interest rates and do the thing that's hard. Well, that caused the dollar to soar, which actually, because of how commodities are priced, it caused the commodities to go down in price for us who buy in U.S. dollars, but became more expensive for other nations who use their own foreign currency, and then they have to trade into our dollars.
That's excellent analysis, David. I want an answer to the question. Has the downgrade changed your forecast for the stock market going forward?
Stuart, I personally believe that we are going to see a very rough third and fourth quarter here in this year, as also looking into the new year. The U.S. downturn is going to cause interest rates and inflation to go up. Treasuries are going to be more costly, as you just reported a moment ago. This makes us our money worth less. Right. And just follow the statement on that, worth less right now. So yes, the market does not like imbalances, and we're going to see a lot of them as a result of just even this little fluctuation right now, as there's a de-dollarization going on globally.
So going forward, we're in trouble. If you're a stock market investor, you watch out. Is that your message?
I believe that we need to watch out. We also need diversification. As I've been talking about, metals can be a very important part of a portfolio. I think oil is going to go up quite a bit. Metal miners, though, if you look at their PE ratios relative to the S&P 500, there's almost never been a better time to purchase metal miners today than right now. So there's opportunities in this market, Stuart. It's just that we need to be very cautiously optimistic as we move forward here, because there's a lot of red warning flashing signs right now that are not silencing.
What's wrong with the 5% yield on a 6-month Treasury?
Hey, it sounds great, but ultimately, if the U.S. dollar begins to slip more and the rates go higher, well, you're just going to have the reverse seesaw component here, which is going to make your money worth less, as the new ones might be worth 6%. I think we're going to probably get to 8% mortgages by the end of 2023 as well, which of course really cripples our housing market, and that's a lagging indicator of where our economy is going. So there's just not a lot of great, sentiment moving forward. There's a lot of challenges ahead of us.
It's a bit of a downer altogether, isn't it? David, thanks very much for joining us. We don't care what the message is, so long as you deliver it well. Thank you very much, David.
Yes, sir.
All right. Back to the stock market. I'm looking at